We are talking about a strangle, and that is a options trading strategy. I hope you guys don't strangle anybody. That is not what I meant. But this is a options trading strategy where you can utilize and play catalyst like earnings and make money if the stock goes up or down. Now, I want to make this video because most companies are reporting earnings starting tomorrow, April 26th, through about the end of May. So this is a strategy you guys can start to implement right away that has a very, very high success rate. Now, I'm going to tell you guys when to use this and how I use this, because you can't use this on every single stock. You really have to know a little bit about what you're doing and how the stock moves. So we will get into that later into the video. All I ask for this video, if you do like it or you get anything out of it, is to hit the like button, comment down below, subscribe to the channel, and consider hitting the notification bell if you want to stay up to date with these videos as soon as they are posted. All right, so the Strangle is a very, very simple options trading strategy that basically anybody that has even never traded options before can implement this strategy. Now, I do advise you to be cautious if you've never traded options before, but this can be a good strategy to use even if you have never traded options before. Now, the biggest thing I do want to point out is you have to have a company that can move on a catalyst, preferably a growth stock. And in this case, I am going to use NEO because I do think they are going to move big on their earnings April 29th. And essentially, how you actually do this trade, you can do this in two parts or just all in one. So basically, the way you do this, you have to know the actual earnings date call or whatever catalyst you are using. I really only do this around earnings because stocks can move big. So NEO's earnings are April 29th. That falls on a Thursday. These April 30th contracts are on Friday. So let's say you bought the contracts for April 30th expiration date. If NEO does not move enough to actually get in the money, you are going to lose basically all of your value by the next day. So that is why I like to go out to the next expiration day out from your earnings call, especially if it is later in the week, like Thursday or even Wednesday. Now, if earnings for your company that you're wanting to play this on is Monday or Tuesday, then I might do that same week expiration date, if that makes sense. But if, like this case, it's Thursday on NEO, then I'm not going to do the April 30th. I'm going to do the May 7th. And how you do this all in one trade is and keep in mind the same price, because you're going to want to do the call and the put for around the same price. You don't want to fluctuate out too far in prices. So basically, if you're saying, okay, I think if NEO has a really good earnings, NEO could go to $49 a share or somewhat close to that, or I'll just use $48 a share for this example, because I think NEO could probably go to $50 a share if they have good earnings. So I do agree with this. So I could buy this and it's plus just like this on Robinhood, and then you go to the put side and then you come down. And keep in mind this price. This price is very important, guys. $53 a share. So on the put side, you'd want to come down to the contract that is closest to this price. And that, the 53, it would be the $36 put for $56 a piece, and then you'd click buy that, and then it comes up simple and easy on Robinhood as a long strangle. So essentially, you're putting about the same amount on the call and the put side, and the fact you have an extra week on these contracts and NEO reports earnings Thursday, if NEO stock doesn't do very much, it only moves, let's say 1 or 2% come earnings, which is very unlikely, then these calls will probably lose these calls and puts will probably lose about half their value. So worst case scenario, I've come to found that you lose about 50%. So you're not guaranteed to lose everything. It's not like that. About 50% is what you're pretty much guaranteed to lose if you do the next expiration date out. If you did the April 30th, then you'll probably lose about 90% of the value. Now, the only way you don't walk away with about 50% of the total cost you put on the trade is if nothing happens with NEO's earnings. Let's say they stay the same price, $41.43 a share come earnings. earnings. If you just completely forgot about it, obviously if it didn't move up or down, these contracts are going to drop about 50%, like I've already said, and you'd be worth about $50 some on this actual trade. At that point, you're better off just closing the position out, taking the 50% loss, and walking away. Now, why this is the best strategy to use around earnings? One, because earnings can be a huge catalyst to move the stock up or down, sometimes 20-30% if you have a real shocker of an earnings report. Now, with that being said, you can make a lot of money if the stock price moves up or down 10 to 20, 30%. You can make a lot of money, but I never ever recommend to do more than one of these at a time, because let's say you did 5 of these, that's $545. If that drops in half, 50%, that's about $250 immediately you would lose, and that's just not worth it as a risk to reward ratio. I have had strangles that are about $100 a piece turn into $1,000 a piece multiple times, uncountable amount of times, but it's just not worth it to do more than one strangle on any given company for earnings. And like I said in the beginning of the video, you only want to do this on companies that move big. Now, I wanted to make this video kind of short, so I'm going to wrap it up here, but we went over everything, how to do this, when to do this. Now, when it comes down to specific stocks, you guys are going to have to come to that conclusion for yourselves. Do you think it will move big? Yes or no? That is all you have to ask for yourself. If you do think so, then go ahead and do these strangles. Now, that is not a recommendation. You can lose on these strangles as well, like I said, about 50% every single time if you are wrong in that. Now, that all comes down to the stocks that you are playing, and it varies from case to case. So like I said, I just want to make this video short, quick, and simple so you guys can come back and use this as a reference if you need to, and if you forget how to do this. So with that being said, if you got anything useful out of the video, hopefully you did, hit the like button, comment down below, subscribe to the channel, and hit the notification bell if you want to stay up to date with these videos as soon as I post them. I hope you guys have a great trading week going ahead. I will see you guys later. Peace out.